Have you ever wondered how a huge company like Apple really counts its money? It's not as simple as just waiting for cash to land in the bank account. Today, we're going to follow the entire journey of a single sale, from the moment you click buy to the final dollar, to see how it all really gets accounted for. So let's kick things off with the most fundamental question. When does a sale officially actually count on a company's books? Think about it. If you sell something today, but the customer doesn't pay you until next month, did you make money today or next month? The answer isn't quite what you'd expect.
You see, when it comes to accounting, cash isn't always king. There's a formal set of rules that dictates the exact moment a company is allowed to claim revenue. And it's all about fulfilling your promises, not just about collecting the cash.
We're going to break this journey down into 4 key stages. First, we'll hit the starting line and figure out how revenue is recognized. Then we get into the waiting game of accounts receivable. After that, it's time for a little reality check about the risk of people not paying. And finally, we'll check out the report card to see how fast a company actually gets its cash. Okay, let's start right at the beginning. This first step is absolutely crucial, and it's called revenue recognition. This is the official rulebook for when a company can actually put a sale down on its income statement. The whole process follows 5 key steps. First off, there has to be a contract. Simple enough. Second, what did the company actually promise to do or deliver? These are its performance obligations. Third, how much does it cost? That's the transaction price. Fourth, if there's more than one promise, you have to split the price up. And finally, and this is the big one, you only recognize the revenue as you fulfill those promises. And here's how this plays out in the real world. Think about a health club. Let's say you pay $1,000 for a 1-year membership upfront. The gym can't just count all that money on day one. Nope. They have to recognize it little by little, month by month, over the whole year as they provide the service. Or take Apple. If you buy a $2,000 Mac that comes with a $500 warranty, they recognize the money for the computer right away, but the money for the warranty, that gets recognized over the life of the warranty. It all comes back to when the obligation is met. So, the sale is officially on the books. That's great. But what if the cash hasn't actually arrived yet? Well, that brings us to our second stage, the waiting game, or what I like to call the company's IOUs. This list of IOUs has an official name, and you've probably heard it, accounts receivable. It's basically all the money owed to a business by its customers, and it's actually considered an asset on the company's balance sheet because it represents cash they expect to get in the door pretty soon. But here's the catch, and this is where accounting gets really smart and, a little bit pessimistic. Companies know that in reality, not every single customer is going to pay what they owe, so they report their receivables net of the allowance for uncollectible accounts. In plain English, that means they're already subtracting an estimate of the money they think they're never going to see. Okay, let's move on to stage 3 and see how this works. It's time for the reality check. How does a company actually deal with the fact that some bills are just never getting paid? It kind of sounds like they'd need a crystal ball, right? How on earth can a company estimate how much money it's going to lose from customers who ghost them? Well, it turns out they have a surprisingly logical system for it. It's called an aging analysis. And what the company does is it looks at all of its IOUs, its receivables, and sorts them into different buckets based on how old they are. How many days has it been since the invoice went out? So check out this example. For the $70,000 in really fresh invoices, less than 30 days old, the company estimates, probably from past experience, that only about 1% will go bad. But look what happens as the debts get older. For that $2,000 that's been sitting there for over 90 days, the risk jumps way up to 20%. So the crucial point here is a really simple, intuitive idea. The longer you have to wait for someone to pay you back, the lower the chances are that you're ever going to see that money. The aging analysis just takes that gut feeling and turns it into a real calculation. So by adding up the estimated bad debt from each of those age buckets, the company gets a total. In this case, it's $2,900. That's their allowance for uncollectible accounts. It's the amount they proactively set aside for the losses they're expecting. Now, what happens when a company is 100% sure a specific customer is just never, ever going to pay? That's when they do something called a write-off. They formally take that specific IOU off their books completely. And here is a fantastic and kind of counterintuitive little fact. When that write-off actually happens, it has zero effect on the company's income for that period. Why? Well, because the expense was already recognized way back when the company created the allowance. The write-off is really just an administrative task, cleaning up the books for a loss they had already planned for. Okay, we've seen how a sale gets on the books and how companies plan for losses. Let's get to our final section, the report card. How can we, as investors or just curious observers, grade a company on how good it is at actually collecting all this money it's owed? The key metric for this is called Accounts Receivable Days, or AR days for short. It's a simple number that tells you, on average, how many days it takes for a company to turn a sale into cold, hard cash. And, you guessed it, a lower number is almost always better. And figuring it out is pretty easy. You just take the company's total accounts receivable, divide it by their total sales for the year, and then multiply by 365. That gives you the average collection period, in days. So let's make this real. If we look at Apple's product sales, their AR days is about 41. What that means is, on average, from the moment they sell an iPhone or a Mac to a retailer, it takes them 41 days to actually get the cash for it. That one little number tells you so much about how efficient their whole collection process is. And that completes the journey. As you can see, a sale is so much more than a simple cash transaction. So let's just quickly recap the key takeaways here. First, revenue gets recognized when a promise is fulfilled, not just when cash comes in. Second, accounts receivable is basically the IOU waiting room. Third, companies have to be realists. They have to estimate and account for the bills they know they'll never get. And finally, AR days is a fantastic report card for judging how quickly a company turns those IOUs back into cash. So, the next time you're looking at a company's financial report, don't just glance at the big sales number. Dig a little deeper. Look at their accounts receivable. Because now that you know the whole story of a sale, you can ask a much smarter question. Just how healthy are their IOUs?